Welcome to F.A.C.E, Jamie.
Good morning. Thanks for having me, Dale. Can you see me
It's
okay?
great. It's great to have you. If you want to turn your camera on, I didn't shave, but I'll do it. And we could do the talking head format like we
Hold
talked
on, the
about.
camera.
It's just, you don't have a camera?
I do.
Oh, okay. All right. So everyone, Jamie writes a column for Reuters, and I thought it'd be very interesting to talk to him, have a journalistic take on what's going on. And are you able to turn your camera
on? Dale, it says that you've turned it off. You cannot start your video because the host has stopped it.
Okay, so I'm going to make you a co-host. Now try it.
There we go.
There we go. Nice to meet you, Jamie.
You too, Dale. Thanks for having me on.
Time.
And before we start, can I just say thank you to Blake, and your check is in the post.
Yeah, he's a great shill, isn't he?
You're welcome, Jamie.
All right. So Jamie, I have to ask you, what came first? Interest in the financial markets or journalism?
Probably journalism, if I'm honest. But it was, if I'm being even more honest, it was probably neither. I kind of fell into journalism, and it was in financial markets that was the beat, that was the field that I started in, and that was in 1998 in Brazil, and I've been doing it ever since. So I mean, I've got no background in finance or markets or economics. It's just been learning on the job these past 24 years.
Sounds like a lot of traders learning on the job. So was that first post in Brazil also with Reuters?
No, that was with Dow Jones. Back in the day,
Okay.
That was with Dow Jones Newswires, which I believe has now kind of been folded into the Journal. It's the wire service for the Journal. But that was with Dow Jones. Back then, it was its own wire service, competing, very handily with Reuters and Bloomberg. So it was with Dow Jones.
Okay, so you just fell into it. You didn't dream about it in school, or it wasn't a goal of yours to be a journalist. You just fell into it. You were unemployed and you were ready to take anything?
That was pretty much it. I was in Brazil. I was teaching English because I'd graduated in Spanish and Portuguese. So I was in Brazil teaching English. And being out there back in the mid-90s, you tend to fall in with the expat community. And so many of my friends were English and American. And a couple of them worked as journalists or translators. That's how I started, actually. It was translating business news for...
And you saw firsthand on the ground some, wild economic conditions that were,
very much so. Very much so. I started in 1998.
Okay.
September, October 98 was when I started. And as you guys will know, or you guys of a certain vintage will know, around about that time, that was the Asian crisis, or the aftermath of the Asian crisis, Russia default. And then, of course, at that very time I was starting, the first week I started was LTCM. Oh,
yeah, the geniuses that couldn't lose.
Well, exactly. And I'm just, when you look back at it, I think the Fed bailout was what, $4 billion?
Yeah.
Which is, pocket change.
Yeah, that's like going out to McDonald's for them now. So Jamie has a column, and I went through your feed, Jamie, and I noticed there's a common theme with what you've been tweeting and most likely what you're writing about. And it seems to be you're a Fed watcher here. And you mentioned that I believe it was February 10th when the 10-year yield really shot up about 15 to 20 pips in a day. Mm-hmm. That was the biggest shock since Volcker. Hard for me to believe.
That was the guys at Deutsche Bank. I don't know if you get their research or have access to it, but that was Jim Reed at Deutsche Bank. And I can't remember exactly what his metric was, but it was based on volatility, daily vol relative to the average over the last 12 months. I think something like that. And that was the highest, as you say, or the biggest vol shock since Volcker, 81 or so. So, I mean, that's a measure of how interesting these times are right now.
Right. And you talk about the small amount of money that was needed to bail out long-term capital. When Volcker was able to take rates up towards 20%, the debt structure of the U.S. was completely different,
Very different. Yeah.
and now you're writing about the Fed, and it seems to me that you have recession warnings that you're writing about, and that the Fed is tightening into weakening economic conditions. Is that your concern?
I think that's fair to say. I mean, listen, we all know what the yield curve or the twos, tens, or any part of the yield curve, we all know what they indicate or what they don't indicate. You can have your view on that. But I mean, it is an incontrovertible fact that the twos, tens inversion has preceded, I think, every single one of the last 6 recessions. So going back to the early 80s, late 70s. Before that, slightly different story, but certainly the last 6 US recessions have been preceded by an inversion of the curve, whether that's a month or two before, a couple of years before. So again, is that causation or is that correlation? Everyone has their own view on that. And another sort of red flag that I've been looking at, and this is one that's been promoted or flagged very much by Professor David Blanchflower, who's a former Bank of England rate setter.
I've interviewed Danny.
You know Danny well, yeah. Now he's quite a character, and not everybody agrees with his views. But he's a labour market economist, and he did a research paper towards the end of last year with a colleague whose name escapes me. But they were looking at consumer sentiment, the UMISH sentiment, and other gauges of consumer sentiment.
Happiness. He measures happiness.
Well, define happiness.
But his $1 more than you need every month.
Well,
and misery is $1 less than you need every month.
If only it were that simple. But his paper found that consumer sentiment, big falls in US consumer sentiment, are key red flags and alarm bells that we should really pay attention to, and they always precede recession. And we've all seen the UMISH consumer sentiment numbers lately, the lowest in 10 or 11 years. The magnitude of month-to-month falls is pretty chunky. So you put that together with the yield curve inversion warnings or flattening curves, etc. You do get a sense that something may be coming on the horizon. Maybe not this year, but next year. And also, just one more point on that, I think if you look at certain parts of the forward parts of the money market curves, Fed fund futures, you find that rate cuts are being priced into late 23, early 24.
Yeah, and who knows, they could come sooner.
It could come sooner, but right now we're looking at 23, 24. It may not be pretty for the economy, and all that depends as well how far the Fed goes. It may take a step back, take its foot off the gas, and think twice about 7 hikes this year, for example.
What's your guess for the first one, 25 or 50?
Well, maybe the head says
try and make a statement by going with 50 and maybe even some balance sheet drawdown.
Maybe the head says 25. But if you look at the Fed commentary in the last week or so, since 50 has been virtually fully priced in.
Bullard.
Well, does he speak for the committee or not? Probably not. Yeah. But even the others on the committee who've given press interviews lately, none of them have really pushed back firmly against the idea for 50. So you have to assume that to some extent they're happy with the current market pricing. So maybe it is 50.
I suspect, and I know that Greenspan used to, the Fed does follow the price of gold. And the signal gold's giving right now is they probably need to do a little bit more than a little less, unless it's just, safe haven flows because of geo matters. You made a very interesting comment. We tend to look at things simplistic. Well, the Fed made a mistake. They were loose too long. And all they're going to do is just even out the playing field and too tight. And it doesn't make it even. You say that it's additive, okay, rather than balancing. So can you just talk about how, just because they're going back to what's normalcy, it still can cause problems?
I think that was actually, I can't claim credit for that quote. That was from the guys at Citi, I think.
Oh, okay. You must have retweeted it then.
I did. And
okay.
I hope I didn't pass it off as mine. But it's a good point, and I think essentially what they're saying is two wrongs don't make a right.
Yeah.
I mean, just because you've swung, maybe because you've been too accommodative in the past. Listen, we can't turn back the clock. There's no going back to you can't change that. But what you should avoid is going too far in the opposite direction to try and balance it out, because that's not how it works. Two wrongs don't make a right. So they have to manage the situation as they see it, not as they maybe would like it to be in an ideal world.
Do you think that the Fed cares about the dollar, and could they use it as a tool by weakening the dollar? I know the rest of the world would like to see that, but isn't that a way to kind of soften the blow of tightening by weakening the dollar?
What was it somebody once said? Our currency, your problem.
Yeah.
Well, is our, I mean, I'm speaking from the US here, is our currency, right. And I don't think the dollar's a problem right now. I don't think that is first and foremost on the Fed's radar right now. However, of course, that can change if there was to be anything resembling a run on the dollar, or it was to show signs of strengthening sharply on the back of these, hike expectations. Yeah. Obviously, a strong dollar does, tightens financial conditions. I think the Fed's very cognizant of financial conditions, and I think where the dollar to contribute to an unwarranted or unwanted tightening in financial conditions, that's when it would come on the Fed's radar. But here we are, 113, 114 on the euro. It's not going anywhere fast. It doesn't seem to be going anywhere direct. I don't think the Fed would use it specifically or directly as a tool. However, I think they would prefer it to be on the weak side than on the strong side, bearing in mind its contribution to financial conditions.
Okay, you talk about, I wanted to, maybe you could clarify it for me, that a lot of analysts were looking for 2 to 210 on the 10-year, when it was 130, they made some good calls, short bonds, etc. And they're actually, some of these same people that called this rise in yields are actually looking for yields to peak, that they're peaking in here, and that they could begin to fall even back to 1%. So has the market already done what the Fed's going to do as far as yields are concerned? I mean, we're at 195 now. If the Fed goes a quarter, is that may not cause higher yields because we're already there?
Well, I mean, you've been doing
it's a conundrum for me.
It is not, but listen, you know exactly how these things work. If the market gets a whiff of blood in its nostrils, it will run, and it's certainly moved in the last 6 weeks. I mean, in my experience, this shift in market expectations and pricing, and the following shift in analyst expectations has been. I can't recall anything so sudden and so quick and so extreme in such a short space of time. So the market has, as always, run ahead of itself.
Okay,
I think that's fair to say.
Those bond vigilantes.
Sorry?
Those bond vigilantes that were around in the 80s.
Well, they certainly, they moved in the last 6 weeks. I mean, we got to 210.
Yeah.
So I think we're in for a period of cooling off. As you mentioned earlier, we've got geopolitics on our radar as well. That situation is bound to put a bit of a bid under bonds. I think we saw today the Bank of America weekly fund manager flow data, 7.4 billion inflows into treasury funds last week. That's the highest in 2 years.
Okay.
So when you get to 2% on the 10-year, you've got things bubbling away in the background, fears of policy error, geopolitics, Russia, Ukraine. There are going to be buyers of bonds out there, and potentially big buyers of bonds. So do we run up to 250? Not so quickly, perhaps. Although I was interested to see only yesterday the bond strategist at Credit Suisse, whose name escapes me, but the chief US guy, he revised up his treasury call, his 10-year call, to 270 for this year.
Wow.
So 270, given where we've come from in such a short space of time, that seems to be on the extreme side. However, 3 or 4 weeks ago, I thought 7 Fed hikes was extreme from Bank of America. Now that's almost consensus.
Okay, so we know what people are buying. I also saw a tweet where you talk about that acronyms do not last, like FANG and MAGA. I'm trying to think of an acronym that people used to use that's not around anymore. Do you have a couple?
Well, there was one that I didn't mention in the piece, but one that, as you'll remember from the Eurozone debt crisis, at the peak or the depths, if you like, of the crisis, was pigs.
Oh, that's
Remember
right.
the pigs?
That's right. Yeah.
Portugal, Ireland, Italy, Greece, and Spain.
Greece, yeah.
Basically the Southern European Eurozone bonds plus Ireland. All of these countries to varying degrees were in big trouble with their debt and bond spreads, and so the acronym was PIGS. Of course, Ireland got a bailout first, and then they were taken out, but it was still PIGS because there were two I's. And for the obvious reasons, there were no PIGS funds opened up or anything like that. It was rather more insensitive than FANGs.
The ECB just put lipstick on the pigs.
Well, there you go.
Right, and it worked. It worked for quite some time. Could it unravel again?
It's hard to say. I mean, if they survived 2012, then they can probably survive most things, I would think.
Okay.
I mean, don't forget how bad it was back then. I mean,
I
think the spreads on Spanish debt were 700 basis points, 7%, and it was when Draghi got up to speak that day in July in London. Things were teetering on the edge.
They were, and we're not teetering. And you thought that 15 minutes was going to be a long time, and we've gone for 25.
Well, 25. Well, time flies.
No, we've gone 16.
16.
16.
Well, happiness is 1 minute more than you were expecting.
We're on schedule, and Jamie, it's really you should do more of these. You're excellent. You have a great demeanor, and I learned a few things from you today, and I'm so glad I reached out and was able to convince you to come on and try it, and hope to have you back.
Well, that's very kind of you to say, and it's been an absolute pleasure. And listen, if you have me back, then I'm happy to come back. All
right, Jamie. And I don't know if you trade or not. You probably have rules. The Fed can trade, right?
The Fed,
but not journalists, right? I mean, you'd be in jail if you did what some of the Fed governors did, don't you think?
I can't possibly comment.
Anyway, all right. So, Jamie, thank you so much. You're really great. Blake's a fan, and appreciate you coming after a long week to talk to us today, Jamie.
Thank you, Dale, and hopefully I'll speak to you again soon. Have a nice long weekend.
It's a deal. All right. Adios.
All
Jamie could follow Jamie McGeever at Reuters Jamie. Follow him there, or go to Reuters and read his columns. Thank you, Jamie. All right, everyone. Have a great weekend, and we'll see you on Monday. Even though it's President's Day, we're not celebrating our presidents here at ForexAnalytix. Monday, we're going to be working with what's happening geo-wise, and you could join the team in about 20 minutes on the Morning Edge. Thanks again, Jamie. Have a great weekend.
You too. Bye-bye.
See everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.